The week is about to end and the volatility of the markets was rather low in the coming week. The calendar is expected to have high impact financial releases from around the world that could continue to generate the interest of market participants. On the monetary front, we make a start with the release of RBA's interest rate decision during Tuesday's Asian session, while we also highlight the release of the Fed's June meeting minutes. As for financial releases, we make an early start on Monday with Australia's building approvals growth rate for May and continue with Germany's trade data for May, Switzerland's and Turkey's CPI rates for June, as well as Eurozone's forward-looking Sendix index for July. On Tuesday, we get Eurozone's final services and composite PMI figures for June and the US factory orders growth rate for May, while on Wednesday we get Germany's industrial orders for May and from the US the ISM non-manufacturing PMI figure for June. On Thursday, we note the release of Australia's trade data for May, Germany's industrial output for May, UK's Halifax house prices for June, from Canada, May's trade data, and from the US, the ADP national employment figure for June and the weekly initial jobless claims figure. On Friday, we note the release of Japan's current account balance for May and Canada's employment data for June, and we highlight from the US the release of June's employment report. On a more fundamental level, we would also like to express our worries for the further militarization as NATO decided to put up 300,000 soldiers on high alert over Russia. Despite no obvious market reaction being present until now, the issue could potentially have a substantial effect should tensions rise further. Please note that on Monday, the 4th of July, the US markets are to be closed for a public holiday. The USD index is about to end the week higher than the levels it began and definitely higher for the month, recovering all of the lost ground for May and then some. It should be noted that on a fundamental level, market worries for a possible recession in the US economy are still present, given also that the final GDP rate for Q1 showed a shrinking of minus 1.6% quarter-on-quarter on an annualized basis, and we note that US financial releases tended to show a retreat at all levels, maybe with inflation being an exception. Should market worries for a possible recession intensify, we may see risky assets, such as stocks, suffering losses, as the market may be more cautious. On the other hand, the Fed's steep rate hike path seems to be increasing the chances for a recession in the US economy, as the consecutive rate hikes on the bank's agenda over the coming months could slow down the expansion, if not contract economic activity. The decisiveness, as displayed in the speech of Fed Chairman Powell at the ECB Central Banking Forum, was characteristic of the Fed's intentions. We note that on a monetary level, in the coming week, the Fed's June meeting minutes are to be released and are expected to be scrutinized by market participants about further clues regarding the Fed's purposes. As for financial releases, we note on Tuesday the release of factory orders growth rate for May on Tuesday, and the ISM non-manufacturing PMI figure for June on Wednesday. On Thursday, we get the ADP national employment figure for June, as well as the weekly initial jobless claims figure. While on Friday, we highlight the crown of financial releases for the week, namely the US employment report for June with its NFP figure. The pound is on the retreat against the US dollar, as well as against the euro and JPY, in a sign of a broader weakness. On the monetary front, BOE seems to remain on the 25 basis points per meeting rate hike path. On the one hand, the bank's intentions to get inflation under control in the UK economy are still present, yet on the other hand, the bank seems to maintain a more moderated approach to the issue. It's characteristic that BOE Governor Bailey mentioned in ECB's banking forum in Portugal on Wednesday that the bank may not have to act forcefully to get inflation under control, while he also highlighted the signs of an economic slowdown in the UK economy. Also, we would note that incoming policymaker Dingra, who is to replace Saunders, a hawk, stated that the bank should adopt a more gradual approach to curbing inflationary pressures in the UK economy. Overall, such a stance could weigh on the pound in comparison to the steep hiking paths expected to be followed by the Fed, BOC and RBA. On a political level, the legislation which could allow the UK to scrap the Northern Ireland Protocol has passed a second reading in the UK Parliament. The UK tends to risk a possible trade war with the EU, which could weigh on the outlook of the UK economy. Thus, should frictions in the relationship between the EU and the UK intensify over the issue, we may see the pound weakening somewhat. As for financial releases from the UK, we note that on Tuesday we get the release of UK's final services PMI figure for June, And on Wednesday, UK's construction PMI figure for the same month, while on Friday we get the Halifax house prices for June. The yen is about to end the week strong against the US dollar, the euro and GBP, as the Japanese currency found unexpected support on Friday's Asian session after renewing its visit at its 24-year low level against the US dollar on Wednesday. It should be noted that BOJ's ultra-loose monetary policy could continue to weigh on the Japanese currency. The release of the bank's summary of opinions for the June meeting on Monday tended to reaffirm the bank's dovish approach. It was characteristic that BOJ board members failed to raise the question on whether the bank should raise rates to support the weak yen. On the contrary, there were opinions for a continuation of the ultra-loose monetary policy or even a widening of the easing, and the view of a temporary nature of inflation was also reiterated in the document. Also, all of the above tended to display how deep the dovish stance is rooted in BOJ and how difficult it could be for the bank to tweak its policy. On the other hand, the cabinet representatives stated that the government will be advancing the basic policy 2022 and the vision and the action plan of a new form of capitalism. Through these efforts, it will transform the economy and society, making them more resilient and sustainable, highlighting the possibility for extensive fiscal spending. On a more fundamental level, though, we would like to note that the yen may continue to keep on display its dual nature as a safe haven and a national currency, and could be getting safe haven inflows should market wars intensify and vice versa. Please note, though, that this aspect of the yen seems to have provided support for the currency during Friday's Asian session. As for financial releases in the coming week, we note the release of the services sector PMI for June on Tuesday, and on Friday we note the release of the all household spending for May, as well as the current account balance for the same month. The euro weakened decisively against the US dollar for a third week in a row, as it weakens also against the JPY and seems to be gaining against the GBP. On a monetary level, we note that ECB's intentions to hike rates by 25 basis points in July, that is to be followed by another rate hike in September, were well messaged to the markets. Overall, it should be noted that the bank seems to be fundamentally shifting its stance, and Lagarde's comments were characteristic. The ECB president practically acknowledged that the economic landscape is changing, and we are in an environment where the pre-pandemic low inflation rates are not to return. Practically, we are in a new inflation era. Central banks are expected to acknowledge it and adjust to significantly higher price growth. That would mean for the ECB that it will steepen its rate hike path should inflation continue to rise. It should be noted that Germany's preliminary HIC period for June slowed down on Wednesday, creating some hopes that it may have peaked, yet France's respective HIC period accelerated, practically reminding traders of the high inflationary pressures in the Eurozone. On the other hand, the tighter monetary policy from the ECB could slow down Eurozone's growth rate substantially, if not cause a recession. As for financial releases, we note on Monday the release of Germany's trade data for May and Eurozone's Sendex index for July, while on Wednesday and Thursday we get Germany's industrial orders and output growth rates for May respectively. AUD is about to end the week low against the US dollar, with a wider drop being reported for the month. Aussie traders in the coming week are expected to turn their attention on RBA's interest rate decision on Tuesday's Asian session. The bank is widely expected to hike rates, yet the question is by how much. AUD/ORS imply that the market has fully priced in a 25 basis points rate hike, while it also prices in a 50 basis points rate hike by 71.6%. It should be noted that RBA Governor Lowe in the past weeks had discussed the possibility of a double rate hike, yet seemed to exclude a 75 basis points rise of the cash rate. Overall, and given the market's hawkish expectations, we note that the scenario of a mere 25 basis points rate hike could disappoint traders and weaken those. On the other hand, should the bank deliver double rate hike and maintain a hawkish tone in its forward guidance included in Governor Lowe's accompanying statement, we may see the AUD getting some additional support. On a macroeconomic level, the situation seems to be looking up, as preliminary PMI figures for June on a preliminary basis held their ground or even rose, implying an acceleration of the expansion of economic activity in Australia. Also, the rise above 50 of China's manufacturing PMI figures for the same month tended to imply that the crucial Chinese manufacturing sector expanded, which could lead to fuller order books for Australian exporters of raw materials. As for financial releases in the coming week, we note for Aussie traders the release of Australia's building approvals and trade data on Thursday, with both releases being for May. The CAD is about to end the week at the same levels it began against the US dollar, and it seems as if its strengthening of the week before has been halted. Overall, we tend to maintain our worries for the Canadian economy, given BOC's hawkish intentions in conjunction with Canada's GDP rate slowing down in April. Please note that inflation continued to accelerate in May, despite the bank hiking rates, which is expected to lead to further rate hikes, thus a further slowdown of economic activity and a possible recession in the Canadian economy. Nevertheless, on the monetary front, should BOC policymakers continue to express hawkish intentions, we may see the loonie getting some support. On the other hand, loonie traders are expected also to keep an eye out for oil prices. WTI prices seem to be dropping over the past few days and seem about to continue the 3 consecutive weeks of weakening. The possibility of a tighter supply side for the oil market could push the commodities prices higher, thus also providing some support for the CAD. Statements made by Saudi and United Arab Emirates officials that their oil production capacity is nearing its limits tended to intensify market worries for the supply side of the commodity. On the flip side, extensive market worries for the demand side of the commodity could keep oil prices under pressure. As for financial releases, we note on Monday the release of Canada's manufacturing PMI figure for June, and on Tuesday we get Canada's building permits growth rate for May. On Thursday, we note the release of Canada's trade data for May, and we highlight on Friday the release of Canada's employment data for June. Overall, as a last word, we expect the market to increase volatility, while the US dollar may solidify its dominance in the FX market due to the high impact financial releases as well as the monetary policy events. The events could increase also the general volatility in the FX market, yet we are entering the summer months with a high number of traders starting their vacations, which could slow down the movement as we enter the third quarter. Given though that there are a number of high impact financial releases stemming outside the US, we may see other currencies taking the initiative at certain points of time during the week and act independently. As for the equities markets, the Fed's intentions for further and steeper rate hikes, in conjunction with market worries for a possible recession in the US economy and a global economic slowdown, could maintain the cautious sentiment, which could have an adverse effect on riskier assets such as stocks. Nevertheless, it should be noted that analysts citing a milder recession that are expected are increasing and could play a positive role. Please note that in the FX market, commodity currencies such as the Aussie and the loonie could benefit from an improved market sentiment and vice versa. Finally, gold's price has been dropping for the week as the strengthening of the USD tended to weigh. Overall, for the precious metal, we expect the negative correlation with the US dollar and US yields to remain on display once again. Hence, we may see gold traders paying particular attention to US releases and sentiment, with the release of the US employment report for June with its NFP figure practically being the crown of financial releases.
Indices are used to measure and track how a basket of securities performs. For example, if you're trading the FSCA group, which measures the top 100 companies on the London Stock Exchange, then it means you're opening multiple positions on various stocks at the same time. This enables traders to build a diversified portfolio across various sectors and trade a basket of stocks in a less costly and stressful manner. Traders usually trade indices through CFDs by speculating on the price movement of indices without owning the actual asset. With indices trading, traders do not have to analyze each individual company separately because an index consists of multiple companies. This provides a more precise picture of a country's economic status. Trading a basket of shares instead of individual shares gives traders a more diversified exposure in the ability to hedge against unforeseen fluctuations from economic news updates. The indices market is a liquid market with more trading hours available compared to other markets. Therefore, traders are exposed to more opportunities for an extended period of time. Also, with indices, there is less exposure to risk compared to when trading individual stocks. Price movements are also clearer, and there are less costs involved. Although different indices are traded at different times, there are certain periods of increased volatility, especially before, after major news releases or events in the market. Other factors affecting indices prices are economic news, company announcements, commodity prices, or company financial results. Indices trading enables traders to go long or short, that is by market because traders think that the price will rise, or sell a market because they think it will fall. There is also the ability to trade with leverage and hedge against losses in their trading portfolio as having a collection of various stocks. Traders may sell an index to hedge against losses.
Hello everyone, my name is Emily and welcome to our daily trading tips. The question is, what elevates someone to do world-class trader status? If a trader has a consistent positive performance, there is always room to improve further. A simple action that can be taken is to go back to their trading history and observe their activity. They could break it down and identify what has worked for them and what hasn't. With this, they can find out more about their strengths and weaknesses and do more of what works and less of what doesn't. There is also a chance of getting greedy. This could lead to taking on extra risk to become satisfied. Beware of this huge mistake, as it could be an important lesson. Everyone loves making profits. It feels great to see your account going up. It makes you feel invincible when you feel like a winner. However, this doesn't represent the whole picture when trading. What happens when you have a great idea and you place a trade and the market moves greatly against you? Do you close the position in a huge loss, or do you wait to see if the market returns to previous levels? Now that's a storm of uncertainty and fear and loss. That's the pain that traders face. That's the time when you have to stand and make a decision. No trade can make you or break you, but you have to come face to face with your pain. That's when you expand and grow as a trader. It's important that once you have chosen your trading instrument, that you approach your technical analysis with a drilling approach. Should you decide to trade in the 1-hour chart, start performing technical analysis with a wider 4-hour chart, which will give you a bigger picture of the price action and what the instrument's direction is. Then drill down to the 1-hour chart that interests you to see the current picture of the price action. Drill down to an even shorter time frame chart like the 15-minute chart to get the latest tendencies of the prices. Such an approach could provide you the big picture of instrument you are interested in. Don't rely on making trading decisions based solely on time frames, as you may miss out on the bigger picture. Thank you so much, guys, for joining us today. Stay tuned for our tomorrow's live.